Welcome to the weekly update, where I'll go over the action in the market for the week of January 29th through February 2nd, and then we'll see how things look for the week of February 5th through the 9th. We had another up week with the S&P, led mostly by the mega caps. We are seeing some signs of concern, but that is pretty much always the case, and I'll try to go through and point those out. But for right now, we are looking positive overall. Before I get started, please know that there's a PDF of every video that I do upload, either on YouTube or on Rumble. Sometimes that can be helpful to download that and look that over as you're listening to my analysis and commentary. I do post pivot points each day. There are pivot points that last for the whole month. I just update that chart as each day completes. But then for each individual day, there are intraday pivot points that you can often find quite helpful. And you can find that on the community tab on the YouTube channel. I do have a private Facebook group, not really active, not an awful lot of back and forth, but if you want to come in and maybe change that, you're welcome to give it a try. I did already post a new poll for the upcoming week, and I'll be going over the latest poll here in just a moment. I do like it when people post YouTube comments, but I do get rid of the garbage comments, the crap comments, the spam comments. I try to keep real close tabs on that, and I get rid of those before most of you probably even see them. But if you want to have a little bit of a back and forth, or if you want to interject something, even if you disagree with some of the conclusions that I've reached, you're very welcome to do that. That's what the comments are for. I also post these same videos on Rumble. So I post them on YouTube as well as Rumble. Sometimes I have some uploading problems. Lately, I've been having a few problems with Rumble. Then other times I may have some problems with YouTube, but I try to get those posted in as timely a manner as possible. And here's the link to the Rumble channel if you're accessing this through YouTube. Let's go back and talk about the week session. So for the week, we were up 1.36% for the S&P. And volume was above average, so that's really picking up, and we are seeing a lot healthier on the volume side. We are positive with our technicals. We're looking positive in the daily videos as well, but we're still overbought. We are seeing some negative divergences, which may cause a little bit of concern, but at the same time, we have to follow price, and price is going higher. And so that's what we've been following, at least as it applies to the S&P. It's about inflation and interest rates. Now, the Fed came out this past week and pretty much took any kind of a rate cut off the table for March. So now the market's looking off into the further meetings that will take place in 2024. Now, please keep in mind that the Fed doesn't have to wait until these meetings to do anything. Under an emergency type situation, for example, after 9/11, when the market was closed for a week, the Fed came in and cut interest rates a full percent, and nothing was open at that time. But just to keep things a little bit more out in the open, they usually wait until these meetings in order to announce some kind of a change. We're also dealing with earnings. That was a big reason for the run-up in Friday's session, is Facebook earnings were really well accepted, and that drove the stock up, I think, over 20%. And we still have a lot of earnings that are still yet to come out. There might be some more Fed speak. Now that the meeting is passed, you'll get some of the other folks that are on the FOMC who like to do their federal open mouth committee speech time and TV time and all of that. And so we'll have to see what they say as they say things. Our trend is still strengthening, and it's positive. We're above the moving average. We're above 20, and the green line is on top. So looking at some other indexes for the week, the Dow was up 1.4%. The NASDAQ was up 1.1%. The S&P up 1.4%. And the Russell 2000 small caps, they actually ended up being down. And that's been a disappointment. We saw a really nice upward move in December, but in January, it was MIA. So for the week, just some bullet points to go through. The S&P and the Dow closed at all-time highs on Friday, and then the NASDAQ set all-time highs earlier in the week as well. And all of the indexes, the major indexes that we follow, were up, except for the Russell 2000 small caps. Regional bank stocks were weak. There was a bank that came out, a regional bank, the New York Community Bank. They reported some problems, and I'm just going to categorize that as problems. I'm not going to get into all the details. and said that they would be cutting their dividend by 70%. That's usually not a very good thing to do. The regional banking ETF KRE had dropped 7.2% for the week. This is regional right now. What we're trying to see is, okay, it's been 11 months. We had a banking crisis. We seem to get beyond that. Have we been in the eye of the hurricane right now before it's getting set to get bad again? Is this isolated, or are there going to be more banks that come out and say, well, we're going to have a little problem here and their stock price is going to go down? If we start to see that really pick up any momentum, that could have a real negative impact on the market. The mega caps did outperform the rest of the market. We did have earnings reports that came out from Google, Microsoft, and Google's Alphabet, Apple, Amazon, and Meta, Facebook. And then Boeing also. After Boeing's just been getting hammered, well, they had an earnings report that was really quite positive, and so they ended up jumping up. Some of these were positive, some of them were negative. And then on Wednesday, the FOMC decided to leave rates unchanged. They're currently at 5.25 to 5.5. The statement that they came out with said that the committee does not expect it will be appropriate to reduce the target range until it has gained greater confidence that inflation is moving substantially towards 2%. Okay, that pretty much took March off the table right there. But they're not saying that if things are getting really strong, we're going to come back in and raise rates. So at least that's also been removed, and the market has taken that. They first took this negative on Wednesday, and then as they kind of thought about it, they went, wait, they're not talking about raising rates now. Ooh, maybe we better go in and buy. Fed Chair Powell then said during his press conference, and this is kind of a semi-quote because where I got this from, it was mixed up. So even though it is quoted, there might be some mistakes here. In response to a question, he said, I don't think it is likely that the committee will reach a level of confidence by the time of the March meeting. And he said rate cut data that will feed into this decision, that still needs to be seen. The employment situation report came in much stronger than expected. Now, that could have just tanked the market, but the market's not really worried about the Fed raising rates right now. They've taken that out of what they're saying. And so they kind of got on the other side of it and said, well, this means the economy's doing pretty well. And the Fed says they're not necessarily going to come in and raise rates. Now, that could always change. We can just go with what we see right now. And then the Treasury Department earlier in the week, this really helped bounce things. When they said they're planning to borrow less than was expected, that's usually taken as a good thing, and that helped interest rates go down and stocks go up. And then interest rates ended up falling on the week. Even though they were up strong in Friday's session, they did fall, at least for the 10-year, for the week overall. This is a chart that I've been showing for over 6 months now. This tries to map the blue line, which is inflation, as it applied from 1966 up to 1982. I had this chart going up until about the June or so of this past year. And we do see a decrease in inflation. The reason I keep showing this chart is look what happens after that. This is when we hit some hyperinflation, which we also call stagflation, where we had very high inflation with no economic growth. That was the mid to late 70s. And if you lived through that, you remember it, before things finally started to improve as we worked our way into the 80s. Is it going to work out that way this time? We don't know, but this is something that we can go on as kind of a guideline just to see, okay, just because things are going down right now doesn't always mean that's the way it's going to be. And then we did close a little bit above the 4.02% level. We were at 4.03% for the 10-year. That's slightly above what RenMax says will cut into corporate profits. Here's the poll results. The first question. The banking crisis occurred almost a year ago. Now, this is before this New York Community Bank came out. And I asked this question, do you feel that we're beyond this and that it won't happen again in the near future, or that there's more to come? 63% say there's more to come. And I asked that question again in the upcoming week's poll, because now we have a bank that did come out and say they're having some problems. And do you feel the negative divergences that we've been seeing are a warning sign, or will the divergences eventually confirm any higher moves? We were split 50-50 there. I'm also asking that similar type of question because some of those divergences that we're seeing are becoming a little bit more pronounced, and we're seeing more of them now. Is the January effect for small caps over? 56% said yes. That's kind of where we're at right now. February's finished. No was 44%. And then as of January 26th, the markets are looking rather tired as they continue to be overbought. We've been overbought and we're still overbought, even though we've been working off some of those conditions. Do you feel that this will mark a top before declining, a rest period before going higher, or will the markets continue to remain tired? 50% thought this marked a top. Well, we've climbed another percent since last Friday. The up move will resume. 17%. That's kind of what happened. And the markets will continue to look tired and go sideways. 33%. That's why we look at charts, because if we go based on emotion, there was no logic behind the stock market going up this week, at least from what I can tell. It had every reason to go down, and it tried to go down, but then it came right back. And so that's why I look at charts, because we try to remove as much emotion as possible and then say, okay, that may not feel right, but that's what the charts are saying. The best and most profitable positions or trades or investments you're going to have, they're probably not going to feel like the right thing to do when you're doing it, because you're going against the crowd at that point and against conventional wisdom. All right, just a couple of charts here from Isabel Net. This is one that I show every week, showing how earnings forecasts looking out are still going up. Then, since we did have the employment report coming out, we're following this red line here, even though it's coming back up. Other times when this red line drops below the other horizontal red line, that usually means we go into a recession. Is that going to be what happens this time? This is one of the charts that suggests that, yeah, we might go into a recession. But I can show you just as many charts that suggest that we're not going to go into a recession. And that's why we keep having the debate back and forth. FactSet had a couple of blog posts. This was as of Monday. This is before all of the energy companies started to perform. And it said, just to review where we're at, it's the largest decline in all of the 11 sectors. That's where we're seeing the most damage done, is in the utility sector. Then in Friday's session, there was an update, and I'll try to go through all the blah, blah stuff and leave that out. It says, as of Friday, 46% of the S&P 500 companies have reported. 72% of those that have reported have been above estimates. Okay. And then when you take it all together, earnings are 2.6 above estimates, which is below the average. Okay. And this is trying to calculate things based on all 500 or 505 stocks in the S&P. So that's why we get a little bit of skewed results here. Getting into the intraday chart, we go back to Monday's session where we were flat, and then we saw some nice strength going into the close. Tuesday, we were pretty flat. This was ahead of the Fed day. We ended up gapping lower, and this came about before the market even opened. And then we hit S3 and S4, which we rarely hit. We might have even hit S5 down here, but I don't know how to calculate that. And this is after Chairperson Powell said, no, we're not going to be cutting rates in March. Boom, down goes the market. They had a chance to sleep on it. We gapped a little bit higher, showed some strength on Thursday. And then even though the employment situation report was way stronger than expected, we lost a lot of that before the market opened. But then after the market opened, we just kicked into gear. We went all the way up, and that's when we set the high for the week, even though we closed just a little bit lower than that. So looking at the week, and this is just the 5 trading days, when we look at the indexes, we had the mid caps and the small caps. They were down. All of the other indexes ended up being positive. Then when we go back to the beginning of the year, we still have the mid caps and small caps, which are negative going back to the beginning of 2024. Looking at our sectors, and I have 2 charts because they added another column here. Looking at the most gains, we saw discretionary, which that's what we've been waiting to see. We need to see improvement from discretionary. That's really been lagging behind. Communication has been a strong area already. Staples, it's like, okay, if the economy's doing really well, how come staples are doing so well? That one's a little bit mystifying. When we look at the bottom, we saw where real estate and energy ended up being down when we look at a percentage move. But when we rank them on their scooter score, the closer to 100, the better they're looking. Communication, tech, the financial sector, industrials, and healthcare are doing the best. And then discretionary is doing okay. Then some of the weaker areas, and we get down to the negative areas, which include energy and the utility sector. Here's the relative rotation graph. where the areas that are looking strong, we are seeing real estate show some improvement, and that's as interest rates were coming down. But you can see this is starting to roll over now. The financial sector is still looking pretty strong, and we have tech, one of the stronger areas. Communication is starting to turn back up and showing some improvement, where we have way over here in the lower left-hand corner, that's the weakest of the week. That is the energy sector. Again, looking at the different sectors just for the 5 trading days, we had communication, discretionary staples, healthcare, and industrials. They were up. All of the other sectors were down. Going back to the beginning of the year, we have communication and tech are positive. All of the other sectors are negative. Keeping an eye on sentiment. We did get to a reading of 767 after Friday's close, where looking at the historical chart, we got up over the 75 level, and then we started to come back down. When we get above 75, that's when we start looking to use this as a contrarian indicator. And it's like, okay, if we're falling, sentiment, people are getting a lot more pessimistic, but then we started to bounce, and we're not necessarily extreme. Now, there's 2 ways to look at this. We could go back up and still have some more time before we get extreme positive, or we already put the high in for right now, and we're going to continue to decline if prices fall. Looking at the active asset managers, after being extreme positive at the end of 2023, they really fell back, and they're still showing some improvement, with the latest reading coming in at 87.36. That's pretty optimistic, but we're still below that 90 level. Looking at the VIX, where we actually saw this go up with the line chart, we were pretty much flat to slightly higher with the bar chart. The Ulcer Index is still showing, and we're seeing the same thing on the daily chart, that there's really no fear in the market. The Ridex bear bull ratio, this really spiked up. People were thinking a week ago, well, the market's going to go down. Well, now that the market's going up, this reading has really come down. The latest reading from the American Association of Individual Investors, they're looking pretty optimistic right now, but not overly optimistic. We also follow the red moving average. We're above 0 and advancing. Until we get up in above this pink line here, we can kind of go with this. When we get up into these higher areas, that's when we're starting to look extreme positive. Then looking at comparing cash to the tech sector, when this black line's going down, that means the tech sector is outperforming, and that's what we've been seeing. We did get another read of GDP recently, where now they're starting to project out a little bit, anywhere from about 3%. Now they're projecting it to be up over 4%. When you look at the consensus, it's a little bit over 2% to the upside and about 0.75% to the downside. Here's what it looks like on the bar chart. So now that we're starting to really, we're still focusing on the fourth quarter, but now we're starting to look at, okay, how's the first quarter of 2024 going to play out? We're still declining when we look at the spread between risky and not as risky bonds. As long as this continues to go down, this part of the market is not concerned. We continue to decline with the Chicago Financial Conditions Index, and that's a good thing. It's when we turn and go up above this black line, that's when we get nervous. Then the bank tightening, we still haven't had another reading from this since the beginning of November. This is getting a little outdated now with the real-time SOM recession rule. We're below the red line. It's when we get above the red line, we are concerned. This is updated. This is the smooth U.S. recession probabilities. We're below the black line. When we get above the red line, that's when we get nervous. And then looking at the Brave Butters, Kelly, this was updated last Monday, where we're seeing this coming down. We had been a little bit concerned as this was going back up. Now we've been seeing some declines here. The more that it goes down, the less likely it is looking that we will go into a recession. Keeping an eye on inflation, these are just the daily updates, looking at CPI and PCE inflation readings. Keeping an eye on the Fed. This is as of the close on Friday. We're done with the January meeting now. So now we have to look towards the March meeting. And there's right now a 62% chance that they're going to leave rates where they're at right now. We can see how this changed, where a month ago, they really thought we were going to cut rates. Then a week ago, then a day ago, and then it kind of went up even higher in Friday's session. This is showing a bit of an increase here that we're going to keep rates the same. So they had been anticipating a rate cut. When these start to go back up, that means they're going to not change rates. Now we're looking out to the May meeting, and there's a 59.6% chance that there will be a 25 basis point cut. We can see how this has changed, where a lot more folks are starting to get into that camp right now. Looking at the Fed balance sheet, it's continuing to decline. We also look at this on a year-over-year basis. I know it looks like it's turning back up, but when we look at the numbers over here, we're actually seeing a minus sign. Then looking at breadth, we're positive based on price and volume. We were getting a little bit concerned that volume is lagging a bit on the daily charts, and you could almost make a case for that because we're breaking out based on price where we're just coming back up to this recent high based on volume. We are turning back up with our 4-week moving average of the new highs, new lows, and we're pegged pretty much near the top. We're also continuing to go up at the 10-day, and this is positive on the daily charts as well. We're above zero with the advanced decline ratio. Accumulation distribution is advancing above the moving average. That's positive. Here's our trend. We're above 20. We're above the moving average, and the green line is on top. So we are in a positive trending environment based on the weekly charts. The Erin is still positive. We're above zero and going up, where the green line is on top. That's buyers. The red line is coming down. That's sellers. When you compare the two, that results in the oscillator that we see down below. The mass index is not generating a signal. Looking at the daily chart, we came right up to this pivot point here. And we'll have to see, is that going to end up providing some kind of overhead resistance? Can we break above that? Or is this going to present some kind of a problem? But we're still looking pretty healthy when we look at the daily bars going up here. And then you can see how volume played itself out over the week. No changes in the decision point scorecard. They're pretty much positive across the board with their trend signals, where we're negative in the short and long term and positive in the intermediate term. We're still looking better. We're above the midpoint of the trend channel going back to 2009. This is a longer term chart. And we're breaking out above this previous resistance level now. And anytime we go up, we're showing an improvement there. So when we look at our trend, we're above the moving average based on 50 weeks, and price is above both. And so that is positive. We're also seeing a positive trend with the moving average crossover. We're still below zero with the McClellan oscillator, and we're seeing a little bit of a negative divergence there on the daily charts as well that I'll show you later. We actually declined just a little bit. We're coming down after being extreme with the summation index based on price. We actually turned up slightly based on volume, and we're above zero. Then looking at the Swenlin trading oscillator, we declined based on price and volume, but we're still above zero. And we're seeing pretty much the same thing. We've now crossed below 70. We're seeing this on the daily chart and here on the weekly chart. We're starting to decline. Now, are we going to wear off this 70 condition and go back up? Or is this the beginning of something that's going to see follow through to the downside? And then looking at the PMO, our momentum is still positive, and we're mixed on the daily charts. We're going up with the PMO. We're still positive, even though we declined based on price. We turned up slightly based on volume. And we declined a little bit with the PMOs that are rising. We're showing some improvement with the buy signals. We're still extreme positive with the PMOs above zero, and we're still extreme on the daily chart as well. The percent B is above the midpoint, so that is positive and not giving us an extreme reading. So here's our oscillators. We're positive in the short term, intermediate term, and the long term, where we're seeing a more mixed picture. We're still positive in the long term on the daily charts. It's mixing up a little bit in the intermediate term, where it's turning a little bit, it's not quite turning back to positive yet in the short term. The chicken money flow continues to advance. That is positive. And the chicken oscillator is going up, and we're getting close to this extreme reading. That's something to be aware of. The force index is above zero and advancing. That's positive. We're still extreme positive with the money flow index. And because we had an up week, we're above the midpoint with the rate of change. Going back 50 weeks, yeah, we're breaking out above this red line, but we can go higher than this. But there has been other times when this did mark some kind of a top in the market. The RSI is starting to get extreme when we go back 14 weeks. The weekly special K chart is still negative, but it is trying to turn back up. But this is a long-term chart with a long-term oscillator. That's why we don't get many signals with this chart, where we're still positive on the daily chart. The Stochk RSI is still extreme positive. The Williams percent R is extreme positive. We're still extreme positive with the ultimate oscillator. We're getting very extreme with the vortex. It's shooting up to a very high level right now. The Coppet curve is showing momentum is positive here, and we're above this 100% retracement now. So really the only use for this chart for right now is if we start to decline, we'll be looking at some of these longer term support levels. Our different charts on the weekly chart, we are positive with the Heiken Ashi, we're positive with the Kegi, positive with the Renko, and positive with the 3-line break. And here's the ease of movement where we're looking much more positive. We're also looking pretty positive on the daily chart. And we did see a new X drawn in here for the weekly point and figure chart here, but we're still working off of the signal that was generated last November 20th, which was a double top breakout. Looking at our longer term momentum studies, we're looking good in the long term, intermediate term, and in the short term. We are positive with the Elder's Impulse system for the S&P. We're positive with the parabolic SAR. Here's some daily charts. This one I did do and show for the video from Monday's session. This is a correlation between the VIX and S&P, and we don't get a lot of signals from this chart. We're now starting to come back up into this extreme reading. Now, we could still go higher than this, but a lot of times when we spiked and then started to come down, look at what happened with price after that. Sometimes it meant a continuation, but a lot of times it meant some kind of a decline after that. Just be aware of this, but this might take some time to play out. The skew index is also giving us an extreme reading. Now, this isn't as much directional. This is just that the market is anticipating some kind of a move, and we spent the last 3 sessions in this red area. Whether it's going to be to the upside or the downside is uncertain at this point, but the market is anticipating a move one way or the other. McClellan oscillators below 0 and declining. We're seeing the same negative divergence on the daily chart. So we're declining with the summation index based on price, and we're still advancing slightly based on volume. The NYSE McClellan oscillator is also declining. That's another negative divergence on the daily chart that we're seeing. We're rolling over a bit with the summation index based on price and volume, another negative divergence. And this is another concern where we could be showing some improvement with the momentum of the NASDAQ 100. We dropped below the moving average, but after Friday's move, we're starting to show some improvement there. And we're still looking at this longer term negative divergence between the Dow and the transports. I stopped showing this chart in the daily videos because this is longer term and it's going to take a while for this to play out. I watch these charts every day. And so if they do start to give us some information, I will start to include them again. Some broad market measures, we're now actually should move the red arrow over here, where February tends to be more down when you go from 2020 up through now 2024. So we see a return of about negative 1.8%. And then looking at a plain vanilla chart where the S&P has been setting new all-time highs, we haven't even come back to the previous high with the mid caps, and we still have a ways to go with the small caps. But when we look at the Dow, we are in a solid uptrend and setting new all-time highs. The NASDAQ still has a ways to go to get back to its all-time high, but it's in an uptrend, where the NASDAQ 100 is setting new all-time highs and in an uptrend. Here's a weekly chart of the QQQs just showing that we had another up week. The mid caps are also still in an uptrend when we look longer term, but they've been really choppy and very disappointing, but not as disappointing as the small caps, which still are in a longer term uptrend. But this whole January effect pretty much died with the end of December, and we've been just chopping around since. The NYSE is another broader measure, which continues to be in an uptrend and not quite back to its all-time high. All stocks are setting a new all-time high and in an uptrend. 30 biggest software companies showing some improvement, but really haven't broken out above these previous price levels. The FANG index just keeps setting new high after new high. ARK is still in an uptrend, falling back and has been chopping more or less sideways. Here's the KBW Bank Index, where it was under some pressure this past week. We're coming down after getting extreme positive with the RSI. We're still positive with the momentum, but we are rolling over. And then the deposits show that there's still more money going out of banks than are going into banks. Here's a plain vanilla look at Dow theory, where the Dow setting all-time highs. We have a ways to go to get back to the transports all-time high. First, we want to get past this previous high, then this other high set in 2023, and then go back and go above the all-time high. So we're seeing a divergence, a negative divergence here in 3 different time frames. Then the utilities have been under a lot of pressure and are still going in a downtrend. Here's the CRB index where we're seeing a recent death cross here, even though we did see a bit of a bounce this past week. The CRB index was down. Oil is still chopping around the 70s. We had some negative news come out of the Middle East and oil ended up going down. Figure that one out. Copper still kind of working into a sideways trend. You could say so. I'm not a big symmetrical triangle, hammer. I'm not into that stuff. I believe, first of all, horizontal lines are the most powerful, and then next after that would be trend lines. And I pretty much keep it at that. I have studied all these patterns and everything, but I've seen them fail as much as I've seen them succeed. But that's where I come out. You might come out with a different conclusion. Looking at the dollar, we are bouncing back up, but on the daily chart and here on the weekly chart, we continue to be in a downtrend. Gold, which if you listen to the gold people, no matter what happens to gold, they can rationalize what's going on here. But with the gold ETF, we are in an uptrend, but it's pretty much been chopping sideways. Silver is just, its moving averages are just kind of going back and forth where it's looking a little bit more weak. Keeping an eye on the total bond ETF, we are seeing a real improvement when we look at bonds based on price. But when you compare stocks to bonds, stocks are outperforming. And I'm wondering here, this little spike up and the fact that we're positive with the 1 to 3 month yield, is that something to do with some banking thing that might lure its head at some point in the future? I don't know. It's not normal for this chart to be giving us a positive result, and it has been now for quite some time. Here are the yields where they had been declining. We were flattening out, and then later in the week, we started to go back up. Here's a weekly chart showing the US, UK, and German rates actually declined for the week. We ticked down just a little bit with the Japanese rates. I'm going to include this because this is the 10-year yield, and then when it spiked and started to come down, bad things tended to happen after that. And we don't know. Something like that may be looming in the future, but we don't know about that yet. We can just go by what we see right now in the charts, and we could go back up and set an even higher level above 5%. But for right now, we have not gotten above that, so that's why I've been still including this chart. Then some relative studies where we did have energy doing the best. Well, it fell. So now stocks are in the lead, followed by the dollar, and then energy, where we have gold, and then the price of bonds are in last place, going back to the beginning of 2024. We look at the NASDAQ 100 and the S&P, and both are in solid uptrends, with the NASDAQ 100 outperforming. The S&P 100 is outperforming the rest of the S&P 500. Growth is showing some improvement when compared to value, and that's what we want to see if we're positive on the market. Gold continues to underperform the S&P 500. And when we look at gold versus the dollar, as the dollar's been going up, gold has been under pressure. So that's why we're backing off of this blue trend line. And then we see here in a shorter term chart where bonds continue to underperform stocks. The low volatility to S&P 500 ratio continues to fall. And discretionary, it's not doing great, but it's still hanging in there with an uptrend when compared to staples and taking a ratio of that. Energy is really underperforming the tech sector. And then some of our longer term charts where we did have the low set in October 2022. For right now, that does appear to be the low. And this buy signal that was generated here is indefinitely on the books. We're also seeing 2 recent ZWAG NYSE breadth thrusts that were generated just about a year ago and then about 6 months ago. It's very rare to see any signals. To see 2 within the same year is even more rare. And this is also indefinitely on the books as a buy signal. The Zohorchak method did kick over and give us a full-on buy signal, and that is still continuing. Longer term, here's a trend line going back to the 1987 crash. We're still above this trend line for right now. This is taking that same trend line and only going back to 2017. Where we're above this. This is just to get a better look of price. And then we look at the NYSE new highs minus the new lows. And I know this is a moving average of a moving average. That's why I use this, because what's one of the cardinal rules? Don't use a moving average of a moving average. Okay, I'm going to break that rule. All right. Because if everybody's stuck to the rules, why are there so many people that struggle with trying to get a handle on the markets? So we're above zero and advancing, so that is positive, and that's longer term. This is also a moving average of a moving average, and this is continuing to show some improvement as well. So that is positive. The NASDAQ 100 is still above this longer term trend line going back to 2009. Then we have a ratio between the NASDAQ 100 and the Dow. We are getting close up to this previous high, but we haven't hit that yet. Other times when we hit this level, that ended up being quite negative for the market. Are we going to break above that and set a new high here? Are we going to hit this and then start to turn down? We've been waiting now for quite a while, about 6 months, for this to actually happen, and it hasn't happened yet. This is another thing we're keeping an eye on, the Qs to the small cap ratio. This is coming back up to this previous high level. Are we going to go and set another high, or is this going to present some kind of overhead resistance and start to come down? That could also be quite negative for the market. We are continuing to see an improvement with the NASDAQ new highs, new lows on a cumulative basis, where it had been declining for years. Now it's finally starting to turn up, but we want to watch this because there were other times when it turned up. We want to see this really turn and get some conviction behind it. And then looking at the 3-month yield, where we surpassed where we were back in 2007, and now we're starting to come down. Okay, is this because the economy is stronger and that interest rates are too high now and they're going to have to be lowered? It could be that. Or is this giving us some kind of a warning signal that something really negative is going to happen at some point? Because when something bad happens, that's when they cut interest rates, and this is really going to have a tendency to go down. So, and this is just for Monday's session. What's the outlook? We are positive with our technicals, but we continue to be overbought. The list is a little bit shorter, but we're still overbought nonetheless. We are seeing some weakness signs developing. If you want to see a little bit more in-depth discussion of what I'm talking about, please watch the daily video. We're going to get the S&P Global U.S. Services PMI final reading, and then the big report of Monday's session, and probably for the week, is going to be the ISM non-manufacturing PMI. And then we're keeping an eye on the geopolitical events, but the market is just not all that interested right now. Here's the upcoming economic calendar for the week. We're not going to have any reports on Tuesday. We're not going to have any reports on Friday. And after Monday's session, we get kind of some usual reports that often are not that influential. Seasonally, looking at February 5th, where we're neutral to negative for the Dow, where we're flat out negative with the S&P and NASDAQ. So looking from 2002 up to 2022, Monday's session does not bode well. But when we look at another seasonal chart, we're coming into this orange area here where we tend to do see positive seasonality going forward, but that contradicts some other charts that we see. Here's another one when we have the president in the 4th year of the first term, where we tend to start out kind of flat and then we see strength later on in February. That also contradicts some other seasonal charts, including this one, the Stock Traders Almanac, where we chop sideways and then we see some weakness before we see some strength during an election year. We're coming into the February area where this chart, when the sitting president is running for re-election, we tend to top out in the first third to half of the month of February and then see weakness after that can take us down into the middle to even later part of March. Just be aware of that. Then I just got this before I started recording the video. I haven't received one of these in a couple of months. This is Tom Bowley's research, and based on what he's looking at, and he mainly looks at the NASDAQ 100, we're bearish for the month of February, where we start off kind of positive, we're up. All right. Then we go through a weak time, then we go through a strong time, and then we end up finishing the month a little weaker. And the best industry group is the defense area for this particular time period. Then this is a chart that I was showing in the daily video. I'm only going to show it in the weekly video now, where sometimes we do some weakness later on in February that could go down into March before we see a bounce up out of that. This is put out by Byrd. He has a free email and a newsletter that he puts out once a week that you're welcome to subscribe to. There's a link to the description below this video where we're coming up. And then as we go throughout the month of February, then we start to see some weakness before we see some strength after that. And then we will be in Monday's session, which tends to be the most positive day of the week. So On a historical seasonal basis, we're not looking very good. But if you compare it to 2023, Monday tends to be the most positive day. We will be on the third trading day of the month, where this historically shows a little bit of weakness with the green dashed line. That's the S&P during an election year. And then this is something I've been showing for a while now, where in 2023, it looked like, hey, wait a minute, this looks like what happened back in 1982. And then we bounced up out of that. We're wondering, are we going to continue with strength going forward from here? This is just a big question mark as to what's going to happen for right now. And then this is looking from 1950 up to 2023. How does the S&P perform during February? We're up 40 times, we're down 34 times. So that's a total of 74 years they're measuring, where we're up 54.8% of the time. But even though we're up more than down, we do have a negative return for the month. Then our scenarios, we're not going with the down one right now, even though we are seeing some potential weakness developing and we are overbought. If anything, we still go with the up scenario because that's what our charts are telling us. We're not going with the sideways trend for right now because our ADX, even though they're dropping below their moving averages, they are still above 20, suggesting that we're in a trending environment. The warning signs, the risk on, risk off posture has been useless for the last couple of weeks. The McClellan oscillators and the summation indexes are negatively diverging. And if you want to see those charts more up close and more of an explanation, please watch the daily video. And I forgot to change this. This should be the S&P 500 bullish percent index is declining after being extreme. It's now dropped below the 70 level. The transports are negatively diverging from the Dow, and we're seeing kind of a flip-flop back and forth between positive and negative for the NASDAQ 100 momentum based on the PPO. Some more of our long-term signs. Right now, those long-term weekly charts with the long-term trend lines, that might be signaling that we're at a top, but right now we're above those lines. So for right now, they don't really seem to be doing that. This is a concern that's been going on for a while. The 1 to 3 month short-term bond spread continues to be positive when it should be negative. The 3-month yield is above where it was back in 2007, and it's starting to roll over. We don't know if that's a positive thing or if that's going to eventually give us a warning sign. And then earnings season is kind of roll of the dice. Then our positive signs, growth is still, for the most part, showing some improvement. Our 5-period equity put-call ratio chart is going down. Our oscillators are mixed after most of them were extreme positive. In fact, I think all of them were. The parabolic SAR and the vortex charts are still positive. The bullish percent index for the NASDAQ 100 is positive, but it's over 70, so it's giving an extreme reading. The Copic curve is positive, small and mid-cap growth. We saw a nice little spike up in small cap growth, but just to the higher end of the range that it's been in. It's pretty much chopping sideways. The financial sector is positive. And then our long-term signs, the daily special K chart is positive, where the weekly chart is still negative. The longer-term equity put-call ratio based on 253 periods, it hasn't turned up yet. It's still declining, but it's just trying to turn up. This is very long-term, so it takes a while. The cumulative new highs, new lows are showing some improvement. The Zohorchak method is positive. The Russell small caps and mid caps, even though you wouldn't know it by how they performed in January, they are still in longer-term uptrends. And our longer-term new high, new low study is still positive. And then our other new high, new low long-term study continues to be positive. We've seen 2 ZWAG NYSE breadth thrust buy signals within the past year. That's a very rare event, and those are buy signals, and they're indefinitely on the books. Seasonally and historically, when you look at the best 6 months of the year, February ends up being the worst of the best. And then our longer-term positive seasonality and setups remain, and those are some of the charts that I went through. And then the S&P is above the downtrend channel upper line. I haven't shown that chart in a long time because we're way above that. So our conclusion, we're positive and overbought. Now, this just applies to Monday's session and to the daily charts. We are potentially seeing some signs of weakness. In the short term, we're overbought, but also seeing some weakness. We're mostly just overbought, even though we've worn off some of that. If we continue to decline, or if we go back to declining, then we'll see, is weakness starting to develop there? We are still positive in the long term, even though we are overbought. We have a 150 and a 200 period simple moving average that are still extreme positive. Thank you. I really hope you found this helpful. I hope you have a really good weekend, and I will talk to you in the next video.